Welcome back to AlgoBot, the channel where we break down automated trading strategies for MetaTrader 5, one clear step at a time. I'm your host, and today we're studying an expert advisor called Camarilla Pivot Reversion. This is an intraday mean reversion strategy built around the classic Camarilla pivot levels, a ladder of support and resistance lines calculated from the previous day's price action. Over the next few minutes, you'll learn how those levels are drawn, how the strategy signals a long or a short, and exactly how the code makes its decisions. Remember, this is educational information only and not financial advice. Let's dive in. So what exactly does this expert advisor do? At its heart, Camarilla Pivot Reversion is a mean reversion strategy. Instead of chasing big trending moves, it looks for moments when price stretches away from its center and then drifts back toward it. The tool it uses to define that center and the edges around it is the Camarilla Pivot System. Every trading day, the strategy takes the previous day's high, low, and close, and from those three numbers it calculates a ladder of levels. There's a central pivot, labeled P, which acts as a kind of magnet in the middle. Above and below it sit two pairs of rails. The inner pair, called H3 and L3, are the reversal rails. The outer pair, H4 and L4, are the breakout rails. Once these levels are calculated at the start of the session, they stay fixed for the whole day. They do not repaint or shift around, which makes them easy to study and easy to trust as reference points. The trade idea is the well-known Camarilla behavior. On a normal, non-trending day, price tends to oscillate inside the H3 and L3 band and revert back toward the central pivot. L3 tends to act as fresh support, and H3 tends to act as fresh resistance. The outer H4 and L4 rails mark the point where that reversion idea breaks down and the day becomes a breakout day instead. This approach is designed for a liquid foreign exchange major, such as Eurist or GBP. On the 15-minute chart, the textbook home of Camarilla intraday reversion. It's best suited to traders who are curious about structured, level-based systems and who prefer a defined, rules-driven approach over discretionary guesswork. As always, trading carries risk, and losses are part of the process. Let's walk through the exact logic, step by step. Everything begins once per newly closed bar on the primary time frame. The strategy never peaks at a second chart or a higher time frame. Instead, it rebuilds the previous day's high, low, and close by watching the primary bars roll over from one calendar day to the next. When a new day begins, it freezes the day that just finished and computes the Camarilla ladder from it. With the levels in place, the strategy waits for one of two setups. Consider the long side first. The strategy is looking for a bullish candle, one that closes higher than it opened, whose low dips down to, or slightly pierces, the L3 reversal rail, but which then closes back above L3. This is the signature of support holding. Price probed the level, sellers failed to keep it down, and buyers pushed the close back up. The strategy also checks that the close is still below the central pivot P, so there's room to travel, and that the close is above the outer L4 rail, confirming this is a reversion setup and not a breakout. When those conditions all line up, the strategy signals along. The entry is placed at the current ask price. The take-profit target is the central pivot P, the magnet in the middle. The stop-loss is placed just beyond the L4 rail, at the lower of L4 or the candle's low, minus a volatility buffer. That buffer is sized using the average true range, so it breathes with market conditions. The short side is a mirror image. Here the strategy wants a bearish candle, closing lower than it opened, whose high spikes up to, or slightly pierces, the H3 rail, but which closes back below it. That's resistance holding. The close must sit above the central pivot, leaving room to fall, and below the outer H4 rail. When those match, the strategy signals a short at the bid price, targets the central pivot P, and places its stop just beyond the H4 rail, plus the same average true range buffer. Before any order is placed, one more filter applies. The strategy measures the distance to the target versus the distance to the stop, and it only proceeds when that reward-to-risk ratio meets the minimum you set. It also skips entries when the spread is wider than your limit, and it holds only one position at a time. From there, the structural pivot target and the rail stop quietly manage the exit. Let's look at the actual meta editor code that drives all of this. At the top of the file are the input parameters, the settings you can adjust before running the Expert Advisor. RangeFactor, defaulting to 1.1, is the textbook Camarilla factor that widens or narrows the whole ladder. ZoneFrac defines how close a candle's extreme must come to the rail to count as a touch. ATR period and StopBufferAtr control the average true range stop buffer. Min-reward risk sets the minimum reward to risk the setup must offer. Max spread point skips entries when the spread is too wide, and lots and magic define the order size and the identifier the strategy uses to track its own trades. Now look at the long block on screen. The first line checks that the close is greater than the open, a bullish candle. Then it checks that the candle's low reached down into the L3 zone, that the close finished back above L3, that the close is still below the central pivot, and that it stayed above the L4 rail. When all of that is true, and the reward to risk passes, the code calls trade.buy, passing the lot size, the stop loss below L4, and the target at the central pivot. The short block directly below is the mirror image. It checks for a bearish candle, where the close is less than the open, whose high pushed up into the H3 zone but closed back below it, with the close above the central pivot and below the H4 rail. When those align and the reward to risk check passes, the code calls trade.sell, with the stop loss placed above H4 and the same central pivot as the target. Two clean, symmetrical blocks, one for support holding, one for resistance holding. Now let's bring it all together on the chart. Across the screen, you can see the Camarilla ladder drawn as 5 horizontal lines. In the middle is the central pivot P, our magnet. Just above and below it are the inner reversal rails, H3 and L3. Further out are the outer breakout rails, H4 and L4. Watch how the candles interact with these fixed lines as the session unfolds. On the far left, price is drifting down from the central pivot. The first couple of candles slide lower, edging toward the L3 reversal rail in the lower half of the ladder. Notice there's no rush here. The strategy is simply waiting for price to come to a level, not chasing it. Then comes the setup candle. Watch this one closely. Its low dips down and pierces the L3 rail, poking below it, but by the time the candle finishes, the close has pushed back up above L3. And it's a bullish candle. The close is higher than the open. This is exactly the support holding pattern the strategy is looking for. Sellers tried to break L3, they failed, and buyers reclaimed the level. Because the close is still comfortably below the central pivot and above the outer L4 rail, the setup is valid, and you can see the buy entry marker appear right at that candle. From there, the stop loss sits just below the L4 rail, cushioned by the average true range buffer, while the take profit target is the central pivot P above. Before committing, the strategy compares those two distances, the reward to the target versus the risk to the stop, and only proceeds because the ratio clears the minimum you set. Now follow the next few candles. Price lifts off the L3 rail, climbs steadily, and reaches up toward the middle of the ladder. As it touches the central pivot, the take profit marker appears. The long trade has completed its journey from the reversal rail back to the magnet in the center. That's mean reversion in action. But price doesn't stop there. Momentum carries it higher, up past the central pivot and toward the upper half of the ladder. This sets the stage for the mirror image trade, the short. The candles push up until they approach the H3 reversal rail near the top. Now watch the short setup candle. Its high spikes up and pierces the H3 rail, but the close slips back below it. And this time it's a bearish candle, closing lower than it opened. That's resistance holding. Buyers pushed into H3, failed to stay above it, and sellers dragged the close back down. Because the close is above the central pivot, leaving room to fall, and below the outer H4 rail, the setup is valid. The sell entry marker appears right at that candle. For this short, the stop loss sits just above the H4 rail, again cushioned by the average true range buffer, and the take profit target is once more the central pivot P below. The reward to risk check passes, so the short is placed. Follow the candles that come next. Price rolls over off the H3 rail and slides back down toward the center. As it reaches the central pivot, the second take profit marker appears. The short has done exactly what the long did, only in reverse. It traveled from a reversal rail back to the central magnet. And that's the complete rhythm of Camarilla Pivot Reversion. price stretches out to a reversal rail, shows a candle that rejects the level and closes back inside, and the strategy signals a move back toward the center. Both the long from L3 and the short from H3 share the same destination, the central pivot P, with stops parked safely beyond the outer breakout rails. Of course, not every setup plays out this cleanly. When price pushes through the H4 or L4 rails instead of reverting, that reversion idea fails, and that's precisely why the stops live out there. Let's wrap up. Today we explored the Camarilla Pivot Reversion Expert Advisor for MetaTrader 5. We saw how it builds a fixed ladder of pivot levels from the previous day's range, how it signals a long when the L3 rail holds as support and a short when the H3 rail holds as resistance, and how it targets the central pivot while placing its stop beyond the outer breakout rails. We also walked through the code and a full chart example. Remember, everything here is educational information only and not financial advice. Trading involves risk, and losses do occur. If you found this breakdown helpful, please like the video, subscribe for more MetaTrader 5 strategy analyses, and leave a comment with the strategy you'd like us to study next. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.